Welcome to the Pursuing Points podcast, where it's all about the pursuit of credit card points and miles today so that you can travel the world free of charge tomorrow. And now, your host, Peter Foti.
Hello, everyone. Welcome to the 6th ever Pursuing Points podcast. I am your host, as always, Peter Foti. And today in the podcast, I'm back to a sole host. If you missed the last episode, we had a great conversation with the chief marketing officer of 30k.com. And he and I talked about the product as well as like his personal travel. And it was some pretty interesting stuff. So if you haven't checked that out, I would encourage you to do so. Today's episode, I'm actually going to talk about debunking some common credit card myths. In total, I want to talk about 5 different myths. And basically, these are the things that when I tell people, for instance, that I have a lot of credit cards, or when I tell people, for instance, that I may cancel cards, these are some of the things that I typically hear in response. And generally speaking, they are myths simply because, people tend to fear credit cards, right? But I treat them the same way that I would treat any other tool, right? I mean, you treat things like a chainsaw or a hammer with respect, right? Because even though they serve a purpose, they can be dangerous if you mistreat them or misuse them. And credit cards are really no different. So if you have a lot of credit available to you and you spend it frivolously, then sure, that's going to represent a problem for you. But if you've got it available and you use it responsibly, truly, in my opinion, there's really no greater financial tool than a good credit card, points or no points. So I want to look at some of these myths, see if we can't debunk them. And as always, and I'm sure I'll mention this at the end, but if you have any questions, feel free to reach out, Twitter or in the comment section. So the first one is you should never cancel a credit card. And before I can really debunk this, we sort of just need a brief overview of how your credit score is calculated. I've written articles about this, which I'll link in the show notes, but essentially your credit score is made up of a number of different factors, right? So the first one is something called credit utilization. And what this is all of the credit that is currently available to you divided by all of your outstanding debt. So let's say you've got 2 credit cards, both of which have a $5,000 credit limit. That means that in total, you've got $10,000 in available credit. If you owe $1,000, your total credit utilization is 10%. Okay, and 10% is good. You generally want to stay below 10%. I myself try to stay below 5%, but generally speaking, you want to stay below 10%. Next is just payment history, right? So this is very simply, do you pay your bills on time? And so long as you do, this part of your credit score will remain pretty strong. Third is new credit. So there's 2 different types of credit inquiries, which we're actually going to talk about a little bit later. But for the sake of understanding your credit score, just know that when you apply for a new line of credit, whether it be for an auto loan, a home mortgage, a new credit card, etc., a hard inquiry is placed on your credit report. And generally, those hard inquiries last for about 2 years, although their effects start to go away after, maybe a month or 2. But when they first get added, you will see your score go down a little bit. And credit card companies and financial institutions do this so that others can be made aware through your credit report that you are seeking more credit, right? And this could raise a red flag if you're someone who is seeking credit but maybe owes a lot of money. They're going to say, well, why are you asking us for more credit when you've already got all this credit available to you? So you want to keep that number relatively low, but if your payment history is good and your utilization is low and all these other things are really good, signing up for a new credit card or an auto loan is not really going to hurt your score that much. Fourth is the type of credit that you use. So this is, do you have student loans, auto loans, home mortgages, credit cards, etc.? You just basically want to be diversified. And then lastly is your length of credit history. So effectively, this is how long your credit profile has been around. So if you have one card that you've had for 5 years, your average age will be 5 years or 60 months. And then if today you went out and signed up for a new card, it's now your average age is going to be 30 months because your first card was 60 months. Now this new one is only 1 month divided by 2 cards is 30 months, right? So you've effectively cut your average length in half, right? So that's why, generally speaking, like when I talked about what's in my wallet, I talked about how I have my oldest line of credit in my wallet because it really helps to pull up my average. Whereas on the other side of that, some of my newer cards, they actually are pulling down my average. So now that we sort of understand how your credit card or how your credit score is made up, is canceling a credit card, or should you ever cancel a credit card, right? Is that a myth or not? And it's a myth because there is nothing inherently wrong with canceling a credit card, so long as you fully understand the ramifications of doing so. So one, is it going to lower your average age? So if this is your oldest line of credit, chances are you don't want to cancel it, right? If it's your newest line of credit, chances are it's going to improve or increase your overall credit age because that number is going to be thrown out of the equation. So that's the first question you have to ask yourself. Will this higher or lower my average age of credit history? And then secondly is, what will this do to my credit utilization? So in our example earlier, you had 2 cards, both had a $5,000 limit, and you owed $1,000. Now, if you cancel one of those cards, now you've got a $5,000 limit and you still owe $1,000, right? Which means your utilization has gone from 10% to 20%. You've doubled your utilization just because you canceled that one card. So these are the things that happen when you cancel a credit card. And the reason why when I hear people say, oh, you should never cancel a credit card, is that, this stuff isn't magic, right? So as long as you understand what is going to happen to your credit report when you ultimately cancel the card, there's really nothing to be afraid of. So I recently tried to call and cancel a card. I had run through this little exercise of understanding how it was going to affect my age and utilization, and I was fine with the potential consequences. So ask yourself those 2 questions. Do not be afraid to cancel a credit card, especially if it has an annual fee that you don't think you can afford or one that you're just not getting any value out of. So that was myth number 1. Number 2, having too many credit cards is a bad thing. This is probably the one that you hear the most when you tell people that you've got, I've got about 10 cards in my wallet, something like that. And they always say, oh man, isn't having that many cards, isn't that a bad thing? Doesn't that hurt your credit score? This and that, aren't you worried about having all that money, et cetera, et cetera? So first of all, it actually helps your credit score so long as you don't utilize all of the credit that's being made available to you. So previously I talked about credit utilization. So like recently when I signed up for the Chase Sapphire Reserve in the second episode of this podcast, I was given a pretty hefty credit line. And because my outstanding debt did not increase, my credit score is actually going to improve because my overall available credit increased by such a significant amount, right? So having too many credit cards, and like I said, when you first sign up for the card and you get that hard inquiry, yeah, that is going to drop your score a couple points. I think when I signed up for the reserve, it dropped me about 7 points, but I expect for that to be totally resolved and back to normal within 30 to 60 days. And then, like I said, after 24 months, generally those hard inquiries start to fall off. So there will be a slight bump in the road when you first sign up, but it'll go away relatively quickly. And because of that new credit line, so long as you use it responsibly, you pay off your bill on time or even before it's due, and you keep that utilization number below 10%, your score will actually increase, right? Because generally speaking, right, when you have more cards and you have more credit available to you, it's probably easier to maintain a lower utilization rate. So having too many credit cards is not a bad thing. If you use them responsibly, it's actually a good thing for your credit score. And again, it's just not something to be afraid of. You respect tools because they serve a purpose. Obviously, if you misuse them, they can be harmful, but In this case, there's nothing wrong with having too many credit cards. The third myth is that you should carry a balance to improve your credit score. I've heard this a few times. I've definitely read it online a time or two. Basically, there's really no other way I can say this other than a million times no, right? The way that this works, of course, is that when your credit card cycles, right? So on your statement date, let's say your statement date is, what's today? September 12th. So let's say your statement date is September 12th. Assuming that you're in good standing with the financial institution, you've not made any late payments, you're all caught up, you will have 30 full days from September 12th to pay off whatever balance was on the statement. Right, so if the balance was $100, you've got 30 days between now and then to pay off $100. You should always pay off the balance in full so long as you're able to. If you carry a balance, especially on a rewards card, chances are you are going to be negating any of the possible benefits you may have otherwise earned through the rewards by paying interest. So the interest doesn't kick in until after that 30 days that I just mentioned. So, excuse me, when your account cycles on the 12th, you've got 30 days. The interest doesn't start to kick in until the October 12th. But even still, you do not want to be paying interest, especially on a rewards credit card. And generally, you're going to be paying interest on the full balance, not just what you owe. So in other words, if your statement was for $1,000 and you paid off $900, you're probably still going to be paying interest on that full $1,000 until it's all paid off. Obviously, it'll depend on the bank, but generally speaking, that is how that works. So carrying a balance will not improve your score. If anything, it could hurt your score, especially if you miss a payment or anything like that. And chances are, if you're carrying a balance, you're probably utilizing too much of your credit, which will also drop your score down. So, I try to pay my bill almost every day. So generally in the morning, I will come in and I wrote an article about how I use a tool called Solver to go through all of my accounts, see how much I owe, see how much money I've got available in my checking account, and I will make payments almost on a daily basis. Just because I want all those numbers to be as low as possible. I just want to, use it and pay it off. I treat these very much like debit cards, and that's how I recommend that most people go about this. So the fourth myth is that checking your credit score will actually lower it. So I mentioned before that there's two types of inquiries that happen when you check your credit report. One of them is called a hard inquiry. And again, this is either an auto loan, a home mortgage loan, a credit card, etc. A hard inquiry is when you are asking a financial institution for an additional line of credit. Okay? And when those happen, like I said, your score will go down a few points. Generally, the effects will wear off after 30 to 60 days. And then after 24 months, it should fall off completely. A soft inquiry, however, is one in which either you are checking your score through, say, a website like Credit Karma or Credit Sesame. A potential employer is checking your score as a means of a background check. A credit card company is checking your score to pre-approve you for a credit offer. Those are all examples of where a soft inquiry would be used. And with a soft inquiry, because you are not requesting a new line of credit, your score is not going to be adversely affected. Okay, so you should not be afraid to check your credit score. I check mine, frankly, almost on a daily basis again. Which is a little OCD. And don't get me wrong, sometimes it's probably closer to maybe once a week or even once a month. But, it is something I try to keep an eye on. It's very important, obviously, not just for what we do here with the credit cards and whatnot, but also just to make sure that your identity is safe and that, no one is signing up for mortgages or credit cards or anything like that using your social security number, especially without you knowing. So it's important to keep an eye on it. You don't ever want there to be any surprises with your score. But checking your score, you personally checking it will not lower it. And the last myth we want to talk about is that you should never accept a credit line increase. I've actually heard this one a fair amount, and I think the reason is mainly what I alluded to earlier, right? Where people are scared of credit cards. They are scared of having all of that money made available to them because, God forbid, what if they didn't have the self-discipline necessary not to make use of money that they didn't really have, and then they go into all kinds of debt. And chances are, if you've heard something like this before where, if someone has told you you should never accept a credit line increase, chances are that person, either themselves or maybe they knew a person who got into trouble with credit cards, right? And like I said before, credit cards are tools. So, just because someone cuts their finger off with a chainsaw does not mean that you should excuse yourself from ever using a chainsaw if you need to cut a tree down, right? You should use the best tool available for the job, which, if you want rewards and these sorts of things, they will be credit cards. And as far as this myth goes, the credit line increase, hopefully it's clear why this is a myth, right? If your available credit increases, but your outstanding debt either stays the same or decreases, your credit score will go up. So if a bank offers you a credit line increase, you should always take it. And if you're worried about spending money that you don't have, frankly, you should seriously consider canceling the card altogether. You don't want to put yourself in a position to be tempted into doing something like that, because the damage, of course, can be significant and it could be long lasting, right? So, there are ways around that, and I think I've mentioned a few of them here. Paying your bills every day or as often as you possibly can, keeping an eye on your credit score, doing all these things, and making sure that you understand the full ramifications of all the decisions that you're making. But the bottom line is that this stuff is not magic. Just because you may have heard something somewhere doesn't necessarily mean that it's true. I find that there's a lot of misinformation out there, especially as it pertains to things like credit cards, because so many people have been in trouble with them in the past. But there are certainly rules in place, and I think that overall it seems to be a quote-unquote safer industry now, less predatory practices as far as I can tell. Obviously, if someone finds that to not be the case, please feel free to reach out. I'd love to hear more. But generally speaking, if you're paying your bills on a regular basis, you are checking your credit score and being diligent about the things that you're doing with your credit report, I don't think you're going to have much of an issue. So just to recap, you should never cancel you should never cancel a card. That's a myth. Because like we said, as long as you know the potential effects on your credit score, mainly as it pertains to average age and utilization, you should be fine. Having too many credit cards is a bad thing. That's a myth because, like we said, having a bunch of credit cards can actually improve your score because it'll lower utilization, and over time, your age should increase. You should carry a balance to improve your score. That, of course, is a myth because paying credit card interest is going to negate rewards, and just having a balance is not going to improve your score. Again, having a 0% utilization or a 1% utilization, having credit and not using it is fine. What's not okay is to not have it available to you at all, and what's not fine is to have it available and be using all of it, right? So if you've got $50,000 in available credit to you and you're only using $500, guess what? That is very responsible, and credit card companies are going to like to see that, right? They want to know that just because you've got it made available to you doesn't necessarily mean that you need it or are going to use it. Checking your credit score will lower it is a myth because there's two types of credit inquiries, hard and soft. When you check it, it counts as a soft one, which will not lower your score because you're not asking for a new line of credit. And lastly, you should never accept a credit line increase. That's a myth because if you accept it and your outstanding debts stay the same or decrease, your total credit utilization will actually go down. So those are 5 common credit card myths debunked. As always, like I said before, if you have any questions, comments, concerns, or maybe you have a guest host recommendation, please reach out at Pursuing Points on Twitter. You can leave a comment on the website or use the contact form to send me an email, whatever works for you. But thank you so much for listening, and we'll see you next time.